contact we've made through the ring meeting. Cool. Dan Breslin, that's me. Diamond Equity Investments is our company. We started that in 2006. I say we, but there was no we up until about 2011, 2012. It was just me trying to make deals. We have grown. This year to date, we've done 111 closings as of this afternoon at an average gross profit of $22,650.95 per deal. These markets where we invest are Chicago, Illinois, Atlanta, Georgia, Philadelphia, PA, and Tampa, Florida. So we're primarily in the first three markets, and then Tampa, Florida does an occasional deal, but the occasional deal turns out to be like a really good one, so I ain't quitting anytime soon, if it's economically viable. One of the cool things, Atlanta's a strong market for us. We have one of my partners here, actually, that I'm going to have just briefly. I know I'm a little bit scattered here. Austin, would you come up for me? Austin and I met at the first ring meeting we actually held here in Schaumburg. I'm going to let him tell it, but Austin's the vice president in charge of the Atlanta market right now, which is responsible for, I think, what, like 45% right now of the total number of deals and revenue that we did. So it's a strong market, and we just met in 2015, I think it was. 2016 is when we opened in Atlanta. So we met. We actually made that contact here. So I'm happy to share briefly his story because it's just an example of like how he networked properly and how he got on the radar and how he turned the contact into something valuable. It wasn't like I had to reach out to him, but what he did is an example of like how to do this effectively. That's why I want to have him just quickly share this piece.
Yeah, so he was at dinner when we were eating earlier. He wanted me to share the story, and I was like, why? But you kind of explained it, yeah, a little bit. So originally, this meeting used to be, or I guess one time, it was like upstairs in the same small room. Yeah, like this small little room. And I showed up like 10 minutes early, 15 minutes early, and I knew him from the REI Diamonds podcast, which if you're not listening to it, listen to it. It's jam-packed full of like all the best real estate knowledge. Even before I worked here, it's my favorite real estate podcast.
Just saying.
But no, legit. But I saw him, and I was like, all right, cool. I'm gonna go up, introduce myself, let him know who I am. I hadn't done any real estate deals at that time, and I just walk up and I give my best pitch. I'm Austin. I used to work at Cutco. I'm great at sales, and I'm gonna start real estate, yada yada. And he just kind of standing just like that, like looks at me. He's like. I got done talking for like 5 minutes. And I'm like, all right, well, okay.
So if I do that tonight, this is just how it starts.
So I stayed for the majority of the meeting, ate as many hors d'oeuvres as I wanted to, and then I left. And I was like, okay, cool. But I got his contact information, and then I moved to Atlanta from Chicago because I was living here at the time, and then he never reached out to me, but I consistently reached out to him because I had developed a buyer's list while I was here. And I was like, hey, this buyer wants a deal here. And, finally, after contacting him 3 different times about buyers hitting me up and me telling him I was in Atlanta, I talked to Dan Breslin. I was like, hey, here's my whole, 100 buyers list that I've accumulated from just cold calling these people off of Craigslist. And he's like, well, what are you doing in Atlanta? I was like, well, real estate, and my partner sucks. So I'd be open to talking, and then flew up, met with you a week later, and the rest is history. But I sucked. I seeked to add value to him. I sucked. I sought to add value to him, Aaron. I sought to add value to him. Versus coming up and trying to get something from him. That is the lesson. That's the main point.
Cool. I appreciate you sharing that. Can we give Austin a round of applause? I know I'm scattered a little bit, but I wanted him to come up and share that because when you meet people at these kind of events, sometimes it feels like, man, it's just I go there and it's a waste of time, nothing happens. But there's a level of effort that kind of happens, and there's also time from when you plant the seed to when the seed germinates. So there's people that I did deals with who I met in various places. I'm doing a deal right now with a guy I met 7 or 8 years ago, and he was on my buyer's list. Next thing you know, he calls me, and he's getting the hell out of real estate. I'm buying his whole portfolio. I was all set to offer him $275,000, and he tells me he only wants $240, and I was like, well, fair enough. Don't have to do that then. So you never know when it's going to happen, but like Austin said, he was adding value. He sent me the buyer's list, and I was bewildered. Like, most people are so tit for tat. What am I getting for this? And I'm not advocating for you to run around and give away your wholesale deals or your houses or anything like that. You have to get good value for the things you're putting together, but make sure you figure out what is something of value that you're offering to the people you're trying to do business with in order for it to go up. So like me, I wanted to be the source of deals because I had no money. Dad dropped me off at the ring meeting. What the hell was I going to give to the guys who were already flipping houses and the lenders and the wholesale? I had no money. I couldn't even close a deal. So if I became the source of the deals, then at least I had some addresses and things that I could go talk to people about with prices attached. And my numbers were nonsense, kind of like Austin's on the deals he tried to sell me the next day. It was like listed REO properties. It was like, dude, these are on the MLS for like 65 and you're trying to get me to pay 75? But, you know, a year later, persistence later, we had that meeting here about Atlanta, and then 14 months after that, there was $1 million in revenue generated that we whacked up 50-50. It was a good year. It was a really good year in 2016. So you never know like how far it's going to go when things start from like, geez, like what the hell is going on? Probably left and was pissed off at me. This guy's a cocksucker. I don't like this guy. I'm never coming here. Yeah, I'm moving to Atlanta. So you never know where it's going to go. It's kind of the lesson. So cool, we are now going to talk about real estate prices. So who here thinks, like we talked about, catastrophic problems out here and the prices are going to fall, right? Who has a guess of how far they think prices are going to fall? Anybody want to take a guess? How about you raise your hand? Are we looking at a 5% depreciation in prices over the next 2 years? 5% drop in prices? No takers at all, huh? 10% drop? No? 10? We'll take a 10. We got a 10. 15? Got a 15. So I said 20 to a guy who's the CEO of like a pretty large home buying organization. He also took a mortgage company public with like, I forget how many thousands of employees in this mortgage company. This was 3 years ago, 2 years ago. So 20% drop all day in prices. And he said, man, that's a lot. And I was like, geez, it's a lot. I realized I really didn't pay attention to the numbers. And so like some of my revelation here and what we're going to talk about tonight, I'm trying to feed myself my own bullshit so that I can continue sleeping at night while I continue building my rental portfolio. Does anybody want to continue building a rental portfolio in the room? Has anybody ever lost sleep over your rentals at all in the room? Right? Has anybody not invested? I sat on the sidelines for a number of years. Who has not invested because the market's going to fall again? We're waiting for a better time to buy properties. Anybody want to raise your hands? There's a few, right? That's how I was for years. I'm not buying anything. You know, I didn't get to a place where I started to figure it out. So I wrote the presentation to convince myself. I'm going to share the presentation with everybody here. Some of my team members have already heard some of the information here. So I asked that if I happen to stumble on questions that you guys don't like, ruin it, and we can talk about it from, you know, the group's perspective instead of the inside track. All right, so we have supply and demand. Does everybody get that? Supply and demand in real estate. If there's too many houses on the market, what happens to the price? One caveat about the price drops. There's going to be neighborhoods that fall in value in every marketplace, and there's going to be neighborhoods that will continue to appreciate. Even when the market catastrophically dropped, there was areas where we would see increases. So like this is not a broad sweeping claim that I'm making. There's going to be little niches, but an overall economic argument or case study, if you will, for continuing to buy real estate on my behalf. So we have supply and demand. If there's no demand, if there's a huge vacuum in demand, all of a sudden everyone decides that we're not buying houses anymore. Instead, we're all going to rent rooms in each other's houses. We're going to move in. And so like, you know, 2 people per bedroom, the whole country just decides to do this. What would happen to the prices if all of a sudden we needed half the number of houses? The supply would go up and the price would go down. So we have to have a combination of what is the demand going to do to the pricing in the marketplace, and what is the supply. And one thing we're not going to talk about at all here tonight is the impact of interest rates. Could be a total bogey if the interest rates went up to like 7 or 8%. We're all probably going to be in trouble. But we're not going to address the risk of interest rates here. It's going to be supply and demand only. So what are we in right now? Are we in a seller's market right now? Are we in a buyer's market? Anybody have any ideas or claims? I honestly don't know what it is right now or what it could be in your zip code. Does anybody have any observations to share? Mark? It's a seller's market. Anybody else think? It's a buyer's market. And where is it that you're doing the deals?
In certain pockets in Glenview and Northbrook on the North Shore, Lake Forest.
Lake Forest, North Shore. We're talking about houses that are primarily 4-bedroom, 5-bedroom. We're talking about 3,000, 4,000 square foot houses. What happened to these houses back in 2008? Let's say before that. Let's say 2002, 3, 4, 5.
Well,
They were going up on the North Shore. And Mark, what sections of the area? 250 and below, which is kind of where I'm also advocating the same thing. Some of what's going on, I didn't bring a chart, but I'll explain it. The people who were moving up to the North Shore in 2003 were baby boomers whose children reached the age of about 14 to 18, maybe a little bit younger than that, but these are people who needed 3,000, 4,000 square feet. How old are the 13, 14-year-old kids in 2003 that bought in Lake Forest? How old are they now? 24, 25, 28? They went off to college a few years ago, right? What do a lot of parents do when the kids go off to college? Right? So who's having tons of college-age kids right now? The demand came down because of the demographics of the baby boomers. Like, you know what? We want to get rid of the North Shore thing, and we want to live in a condo down on the Gold Coast. We want to be close to all the nice stores. We only need one extra bedroom if the kids come back from California. So, like, to visit, right? We don't need 3. We don't want them moving back to the house. So those same college-age kids, right, who got out of school a few years ago, what are they doing right now? What houses are they buying? 250, 350, depending on the kind of jobs they got. 400s probably on the high end. A couple of them, they're having kids later than they normally did. A couple of them are having kids, and they're like needing a 3 or 4-bedroom house, and they're moving out of the rental properties that are like completely overbuilt now, completely overbuilt. So like the millennials who are never going to buy houses again because of the Great Recession have been buying houses strong and creating a whole lot of demand in the marketplace over the last couple of years. So there's one driver, an example of where a market's falling and where a market's rising, and something that could be potentially happening to explain that. This was just a chart that I pulled up, right? I just Googled it and said, okay, we have a huge supply of inventory or a significant drop in demand that could make the market crash. Does anybody have any ideas where the inventory came from when the market did crash in 2005, 2006? Where did all the inventory come from? Foreclosures went up, right? Anywhere else? Incomplete new construction, or even completed new construction, depending on where at in the country you were at. I mean, in Atlanta, there's tons of new construction, way out, hour and a half, almost 2 hours from the city. There's like new construction, these 3,000 square foot houses that if they were here, they'd be like 450 grand. You can buy them for like 189. So here's the U.S. existing home in months supply. So if we looked at the other chart, anything less than 6 months is a seller's market. And the chart in 2010 was as high as almost a year. 11 months worth of supply peaked throughout the country in about 2011. And then it kind of made its way down here. And in 14, it started to normalize. That's when a lot of us in the room probably started feeling comfortable flipping houses again. So, oh, okay, look, they're actually selling. This is great. That was around when I moved here. And then the supply continues to stay at a normalized level. A lot of these charts simply did not They did not chart the information before 2010, so we just didn't maybe have that information. Let me see. Too far from the clicker here. Oh, okay, my bad. We did have the information starting from 2000. So here's the normalized, 4 or 5 months worth of supply. Actually, we were supply was actually tighter here in 2000 and 2005, starting in 99. And then it started to increase as we started to see the market soften up in 2006, 7, 8, 9, 10. Do you know what this drop was? Does anybody in the room have a guess what the drop was right here, right at 2010? Huge drop in the months of inventory on the market. Can anybody remember what it was that was driving and causing that drop? What was it? People leaving from stocks coming to real estate. Any other people got in there? Bailout? It was a bailout. Obama, remember the housing tax credit of like 9 or 10 grand or whatever it was? It's like, oh my God, this is great. And so there it was. That ate up some of the inventory and forced people to buy sooner than they would have anticipated doing normally, since they were getting free money. I sold a couple of my houses in there. It worked out well to get out. I mean, as well as it could. It was a bad time. So here is a lot of different economic data. If you pay attention to what's in the box here, this is U.S. housing starts and U.S. building permits. If we go back to 2004, it's green. Green means it's like way high. The numbers are 2 million in 2004. That's 2 million new housing starts, 2 million building permits. Permits would be issued earlier at a larger number, and the starts oftentimes there wouldn't be as many. So here you had 2.1 million permits issued in 2005, but only 1.9 million people got the financing, decided to actually build once the permit was issued. You see that number start to drop, 1.6 million or so in 2006. Because most people who are operating and building at the time, I mean, it's smart money. People made mistakes, but there are smart people who aren't going to just overbuild themselves into a cliff. But 1.6 was still pretty high for housing starts. The normalized number here that we're in is around 1.1, 1.14, 1.2, 1.1. If you went way back in history, all the way into the 90s, around 1 million housing starts per year is what's needed to satisfy housing inventory that's falling off. It's too old, it needs to be torn down, it's some frame, it burned down, it's vacant, it's just obsolete housing. So to replace the housing stock that's becoming obsolete, we need about 1 million. So we had almost 2 million in 2004, 2005, we dropped down to 1 million, so it normalizes in 2007, but from these last 3 years alone, how much extra housing was built that is probably needed? Any guess? Roughly? About 2 million, 2.5 million extra houses. Why did they build so many extra houses? What was going on in the marketplace during that period of time that we could have even absorbed or falsely thought we could have absorbed that? Does anyone remember? Depreciation? Appreciation of property. Easy lending. So we had a combination of the ninja loans, the easy lending, the properties were going up in value, so it motivates everyone because of profit to build new houses. People were buying these properties who had no business buying a house at all, unregulated lending. And then you also had, during the same period of time, 04, 05, you had those baby boomers who were buying all those McMansions, all those 3,000, 4,000 square foot homes. You needed the space. You got these like adult 13, 14, 15-year-old kids living in the house, and it's like you're bursting at the seams, so you're running out and you're getting like a nice new built, new construction home. And then the baby boomer demand starts to evaporate at the same time that the bubble is bursting, so we kind of had a double whammy that caused the dip. 500,000, 600,000. And in 2012, 2013, we start to see new construction starting to pick back up. Does that make sense? Does anybody see where the huge amount of inventory came from? The supply on the market? Does that kind of make sense here? Makes sense, right? Does anybody see the huge amount of inventory, the oversupply right now in the last 5 years? Is there some drastically huge number of new construction housing that's saturating the market and going to cause the prices to drop like crazy? No. Probably not, right?
I just have a question. You broke down your 2018 by quarters, but the other years are not. It's like a full year. So if you combine all these 1 million, 1 million, 1 million, that's your 4 million. I mean, how do you see what I'm saying? This is.
Yeah, that's an average. So it's like an average that's actually like the average is fluctuating. And if we reported that average in quarter 4 of 2018, we're 1.14 million. If we report that average in quarter 1, then we're at like 1.62. So yeah, it's not 4 million in that whole course of that year. There's probably other places here, U.S. Customer Center. I mean, there's other places where maybe like the stocks or something. I'm not really like trying to posit an opinion on the stocks with this chart at all. So I didn't analyze any of the other data. All right, go ahead.
You think we've learned our lesson in the country?
I don't think we learned our lesson. I think that the United States put in regulation to the industry of the mortgage lenders. So like mortgage lenders who were swapping out your loan paperwork when you went to settlement and you didn't read the loan details close enough and you signed up for some, variable rate loan that suddenly jumped to 14%, you've been swindled. Well, that swindling is impossible, and there's like recourse in place, and there's testing in place, and the United States has regulation in place, like they did with the pharmaceutical industry, which is still slightly Wild West, but like, who knows John Rockefeller? Do you know his dad, the patent medicine quack doctor? What the hell was his other name when he changed it? William Rockefeller. Yeah, William Rockefeller. He changed his name to something else. Dr. Livingston. Dr. Livingston is actually John Rockefeller's dad, and he used to sell whatever the hell led special drug in a bottle, and that was what medicine was known as. Well, people aren't quite dying of these like poisonous concoctions anymore because we have regulations. So at least from a lending perspective, the regulations in place to make it a little bit safer. So like, we talked about new supply coming on the market and that being a potential oversupply, which could have been and did help drive down prices back last time around for the catastrophic fall. The other part was the foreclosures. So there's your foreclosures filings here. 450,000 plus foreclosures being filed. That's a new filing. That means they filed less than 150. So like, even as we were getting into it, before the regulation came in place, it was not tracked prior to like, I think like 2000, 2001. But even in 2000, 2002, 2003, these foreclosure rates were pretty high compared to where they are now, which is roughly, I think like 26,000 or so a month, something like that. It's like really low. Go ahead, Dan.
This is nationally?
Yeah.
All right. When you look at those charts, Chicago for the last couple of years actually bucks the national trend for foreclosure starts. It actually, if you look at that, use AACOM data, it shows that in the Chicagoland market, we're actually going counter to the national trend, and our foreclosure starts are still up.
So the foreclosure starts are still up in Chicago. Do you know what the actual numbers are compared to the trend?
I remember the percentage, it was just, we were in the top 10 nationwide. So most
Yeah.
of the nation is following this chart. Chicago has not been.
And I'm perfectly okay with that because I buy a lot of properties from foreclosure short sales and everything. The lists used to be like 10,000 plus records. The lists are like 1,000 records or less in the big cities that we do now. So it's like 10%. And they're still happening. There's some debt increases like auto loans and credit card debts and things of that nature that might be a little bit worrisome, but we are not anywhere near something like this here. I mean, if you look at the national trend, here it is since 2014, it's like drastically much lower. Could it all of a sudden go up and peak? Yeah, I guess it potentially could, but who in the room has applied for and received a mortgage in the last 6 months? 12 months? 2 years? I'm talking about a mortgage like with a bank, not like Josh in the back who's just gonna give it to you because you have a heartbeat.
Sure.
Can anybody have one word to describe how enjoyable the process of obtaining a mortgage is right now? Miserable. Perfect. What was it?
And I got a mortgage in 06 and 2018.
it was way different than it was in 2006. Yeah, you have the money. Yeah, so I've gone through quite a few of them lately, and you gotta have the money or you're not getting the mortgage. You're just not getting the mortgage. There's people who might not have the money who are in the south side of Chicago who are getting their grants to get the settlement, and are getting a settlement with $500 or $1,000 of their own money. And I'm okay selling property to some of those people, because some of them do what they need to do. They're financially disciplined. They bought a 2-flat from me. The one girl, I'm thinking, no, she put $1,000 down to get into the deal, and she's a very high risk to go into foreclosure from like that perspective on those kind of houses, which I think will be in line with what you said, Dan, where it is bigger than the national average. I would be willing to bet that our subsidized purchasing of first houses, which is helping to keep the recovery alive and the inventory low enough where it is on the south side of Chicago, I'd put $1,000 down in a heartbeat that we have a much higher rate of that subsidized down payment assistance here in Chicago than there are in other parts of the country. U.S. household formations. So there's no huge dip here, right? The U.S. household formation would cut in half, and we would be like down along the bottom right here. If everybody wanted to share bedrooms and stuff, like I said earlier, like if we were all gonna, pack in 2 people to a bedroom, and all of a sudden, like the formations would drop. So a household formation is when we're renting a house together and moving out of our parents' house, we're getting married and starting a family, and we're forming a new household. Immigration, people come to the country and there's a new household being formed. So this is a driver of demand. That makes sense, right? For the life of me, I couldn't figure out what the drop is. I have no idea what this anomaly is. I thought it might have something to do with maybe like frozen immigration right after 9/11, but honestly, your guess is as good as mine. Does anybody have a guess on that one? Kind of just a weird anomaly. They may have shut it down and there was no data reported that month. Like, I don't know what that is. But if you see, the household formation was, it went up in the 80s, and just kind of, it's pretty stable across the board. Even though we saw some drops, a few years ago, it looks like a drop in the formations like last year, and we were all sitting at the edge of our chairs, I think. A lot of us who had houses, oh my God, it's 2000. It's the end, it's the crash, it's coming. Well, yeah, maybe there was a dip here in the demand, and that just seems like naturally happened over the course of time here. U.S. population growth. Does it look like it's having some huge drop-off or a trend that may reverse? Even with tighter immigration policies, it's still pretty steady. There's not like huge peaks and valleys in the population growth. It's nice and steady. Even if we came through the 2005 era, we were maybe 30 to 40 million people less in our country 10, 15 years ago. And we're probably like 10% more population in the country now. Makes sense, easy enough, right? Cool, so I pulled this one up for us Midwestern market investors. This is the existing home sale volume. So we had much higher volume. We had 2005, 2004, we had like 160, 170,000 home sales in each of those years at a time when the population had 40 million less people in the country. So like, if we were at the top of the bubble right now, wouldn't we have higher sales volume because we have 30, 40 million, we have 10% higher people in the country. So if we were at an equal place in the bubble of the housing market, shouldn't there be sales volume 10% higher than where we were in 2004? Would that make sense? Even 5%, yet we're roughly 10% less in 2016, which that was kind of the peak, right? That 2016-ish was sort of like, we sort of saw a peak, and we're seeing a small fall off in the volume here. Maybe it'll continue to fall slightly back down. I don't know that I see it going completely down. And isn't it ironic how every year it goes down, up, like throughout the year with the seasonality? Is everybody aware of that seasonality? The ones who are experienced, like, yeah, we know, season, has all that. I was like shocked to see just how like rigidly perfect it actually was. So here's the home vacancy rate. Anybody want to guess what the home vacancy rate is? Like, what does that mean? Yeah, empty houses. So the number of empty houses is pretty low right now. Not quite as low as 1979, but it's pretty low right now. The rate was pretty high. So would that like indicate that demand is strong or demand is weak? Would you think, looking at the chart? The demand is pretty strong right now, right? Not a lot of empty houses out there. U.S. existing home median sales price, we're actually higher than where we were at the end of the bubble. So we've actually surpassed where we were when we're talking about it from a national average. I like this one here, like how sharp and steep does the chart look from 1999 to 2006 versus 2012 to where we're at now. Looks a little bit uniform to me. Goes up, summertime, goes back down, little peak at the end of the summer, goes back down. We're all ready to kill ourselves come December and January when there's no activity. At least I know I am. I'm scared to death thinking it's the end of the world, end of the market. No one's selling houses anymore, and I own like 7 or 8 of them I'm paying 10% on. It's like, or more, or like a significant number more. And then it just keeps coming back. It's like very, very steady. It almost looks like they copied and pasted the same shape, like over and over and over again. I don't know about you, it looks like a pretty regular, stabilized type of chart, if I were a chartist. Yeah, a chartist is a kind of stock investor who utilizes charts and past activity to make bets on future activity using nothing more than charts. So they don't actually look at like revenues of the company, they don't look at the debt of the company, they don't look at the company's leadership or read the annual reports of the company. A chartist buys stocks only based on the chart price activity from the past or the chart volume. That's a chartist. So here we go, Midwest, it's not quite as high as the rest of the country. Again, you know, the example I take away from here, this looked much more sharp and unregular compared to what we've seen here. But if we look, this is a course of like 20 years worth of activity. So we had 20 years worth of appreciation. So I pulled a couple numbers off of that same chart. In the Midwest, the average home sale. So we don't get to see like this like crazy Miami, Florida type appreciation. We don't see like the San Francisco appreciation where you have like a ton of foreign money coming from overseas and like driving prices crazy through the roof. We have like pretty stable market depending on where you're at in the Midwest. But we have 1999, the average sales price was $140,500. And then the average sales price, let's say that was just the same home. We're not going to account for things like repairs, roofs, and rent, and income, and all kinds of other things like that. Same house sold 20 years later at $248,000. The total ROI is 76% on your 20-year hold of that piece of real estate through that initial wild ride up, back down all the way, and then back up to $248,200, that average house. That's only a 2.89% appreciation rate over 20 years. Does that seem unrealistic to have pricing today that's only 2.8% per year? It's average. It's like inflation. So wouldn't I mean, if I saw like 10%, like this is 20 years worth. So if I took like almost that same ride in appreciation from here to here, I actually didn't do that calculation. It probably would have been something like 7 or 8% during that period of time to get us to, 225 or so. It's like, yeah, 8 or 10%. So if I was still at 8 or 10% over the course of 20 years, I feel like I'm looking at normalized pricing in today's market. I honestly don't feel like I'm looking at, oh my God, this is the bottom's going to blow out of this thing and there's going to be this huge buying opportunity. I feel like we're in a really good position as real estate investors right now. So I'm just going to pretend I bought the $140,000 house and I put $35,000 down with closing costs. I borrowed $112,000 after 25 years at 5.75%. I'm sure there's people in the room who are paying much less interest on their loans and probably taking 30-year amortization, but I gotta use commercial mortgages usually when I'm buying, and it's a little higher rate and a little higher amortization. I also like paying off my loans a little bit quicker rather than trying to maximize my cash flow in the near term. For me, a rental house, if I bought the $140,000 house 20 years ago and I used this exact kind of a scenario, after 20 years at 2.89%, the house is worth $248,200. My appreciation gain of $72,700 or 5.78%. I believe I calculated all this on my $35,000. So my $35,000 in real cash as an investment returned 5.78% in the appreciation over the 20 years. So my 35 grand gained 72,700. And then I guess I could have probably added the numbers so they would have made a little more sense as I presented them. My mortgage pay down, which is also the profit, so over those same 20 years, I would have paid down $76,134 with rent checks, not my own money, so it's like my automatic savings plan. And if I sold that same house at that $248,000, or just kind of calculated my gain, my total gain was $148,834. Plus I'd be getting my $35,000 that I tied up in the deal back. But it was basically like parking my $35,000 at 8.65% and just letting it ride. It doesn't sound that sexy. A lot of times, like for me, I wanted to buy Google stock like 20 years ago, or Amazon. Anybody wanted to buy Amazon trading at $65 or $13 at the low? I mean, it makes sense, right? And we want to like chase those kind of unicorn type of investments. At least I know I did. I want to buy Bitcoin for $75, $100. I don't even know what it was when it was super low. You know, I wanted to be the guy that got the 10,000 for delivering the pizza the first time or whatever. That's now worth like 10 million. But like, that's not really the kind of investments that I have access to. I have access to these like average Midwest deals, and this is like why I buy my real estate, because I'm getting a whole lot better situation than I am in the bank. And like the note is, this doesn't include my depreciation or my cash flow, so my rents have probably gone up since 20 years ago. I probably did make some money over time. Like I checked one of my rental portfolio accounts, like, oh my God, there's like 20,000 bucks there, but I didn't touch the money for like 2 years. So the cash flow actually accumulated in that account over that time instead of me trying to spend it. And the other thing is, the note is, this doesn't include the instant equity when you buy right. So how many people in here have the ability to buy a $140,000 house for like $110,000? I'm in the wrong room. It's a good thing you guys came out tonight. So for me, and this is kind of like my mindset when it comes to rental properties. 60, yeah, even less, right? I'm happy to buy. I like buying properties that are rentals right now because I don't have time to do rehabs and like BRRR strategy off of Bigger Pockets. Everybody know about BRRR? Buy, rehab, rent, refinance. That's BRRR. I don't have time to do the rehab on the stuff because we're doing rehabs, we're flipping, we're wholesaling, we're doing all kinds of holding ring meetings. So like my preference when I'm buying a rental property is to buy like the $140,000 house that the seller renovated to like a retail, not retail ready flip, but like a rental grade finish, and the place is worth like I want to be able to sell it right now for $140, not get the appraisal at $140. I want it to actually sell to a real buyer for $140 now, and I'd be happy buying that property like right now at $105, maybe even like $115 or $120 if it's in an area that I think is going to appreciate. So if it's in Bridgeport, I will buy at like 85 cents on the dollar, which most people know is kind of sucker numbers when you're talking about real estate investor dollars, right? Bruce, do you want to buy deals at 60 cents on the dollar or 85 cents on the dollar? 60. 40, yeah, there you go. Someone's telling the truth. So now it's like, I'm buying it for $105,000. I'm building $35,000 like in as a paper gain. I'm putting my $35,000 down, and like right away on my balance sheet, the 35 turned into 70. And so like I'm already sitting on like double the gain, and if I had that 35,000 sitting there and it was like savings, I didn't need it right away. I wasn't trying to live off it. It's literally like almost viewed as retirement money in an IRA, like in this deal for me. I put it to work at 8.65%, and I let it ride. And there's a lot of neighborhoods, like who knows where to buy, even in Chicago. Right now, do you know where to buy in an area that's gonna beat 2.89% appreciation? I'm sure even the people who have no experience at all, never did a deal, can guess at some of the hot areas where something like this might work. So for me, like I'm perfectly okay with the way the market is right now. So where the smart money is holding properties, who knows about Invitation Homes? Couple of them. Invitation Homes was Blackstone, I believe. Blackstone, private equity firm. They raised a bunch of money. They bought a bunch of houses in the crash, and they're continuing to buy houses and operate rental property. Do you think that they buy in areas they think are going to be safe and be at least stable, if not potentially grow in value or have rising rents? Smart money would look for rising rents and potentially rising values. Might not be happy with the tax situation, the property tax situation we're facing in Chicago, but there's safer areas and more risky areas when it comes to property tax too. This is available in the annual report. If you go on, Invitation Homes is now a publicly traded real estate investment trust. You can Google Invitation Homes annual report. You could pull this up. You could read the whole thing. It's like 150 pages. It's enlightening. But the smart money is picking areas like South Florida, Miami. They have 13% of their portfolio put in South Florida, 10% in Tampa, 13% sitting in Atlanta. Do you think Atlanta's a good place to hold real estate? Even if you buy it at full retail value. These guys aren't buying it quite at full retail value, but there's a lot of houses that these guys buy at full retail value, prices that are ridiculous. And none of us in this room would probably pay that kind of a premium by buying it for retail, but it almost makes sense when you're looking at areas that can continue to grow in value. 7% in Phoenix, 3% in Las Vegas, 4% in Chicago. Who would have known that they were trying to hold 4% of their portfolio in Chicago? That's pretty interesting, isn't it? I would think they're smart money. They probably did a lot more research than Dan Breslin did, pulling together a quick 10 charts to do his presentation. So I'm cool with it. Look, I'll buy in Chicago, I'll buy in Atlanta. I'll invest and follow suit. iBuyers, everybody familiar with the iBuyers? Open Doors, Zillow Offers, Redfin, OfferPad, and Knock. So we have a couple of the same ones. Chicago is not on the iBuyers roadmap. Does anybody have any guesses why? Or Philadelphia is actually not on the iBuyers map. Does anybody have any guesses as to why the iBuyers are staying clear for now of Chicago and Atlanta? Or I'm sorry, of Chicago and Philadelphia and some of the other iBuyers, internet buyers, Zillow Offers, Redfin Offers, Open Door, buying houses directly. Dan?
Zillow said that they were going to about a year ago. They said they were getting into Chicago and they were going to start the program. I don't know if they did or not. Obviously, according to the chart, they didn't, but I know they
Yeah, this one might be old. They did announce like 21, but the picture wasn't big enough for me to include, so I didn't. One of the reasons that I know they're staying out of Philadelphia and why a lot of people will stay out of markets like ours is the age of the inventory. Our houses are old. It's expensive to do rewires. There's still knob and tube wiring in some of these houses. There's foundation issues here. In Atlanta, man, it's old to find something. You buy something 1940, 1950 build, that thing is like, you need to just tear that thing down. But like 1940, 1950 here, you're like, yeah, this is a great rehab. This thing's like a prime new house. Let's get this thing started. Same thing with Philadelphia. So it's a lot easier to take 1920s, like, it's not that people, one of my guys who didn't make it here tonight, he's like, yeah, if it's over 100 years old, we're not buying it. So if it's from like the 1880s, he wants to stay away from it. Like, I don't even think there is like 1880s houses in Atlanta I don't even know if it was developed yet. Certainly not at the level that it was here. But you go to Philadelphia, we got houses from like, I think late 1700s somewhere downtown there. Like those things are tiny. Yeah, exactly. Right? Ben Franklin's house is in Philadelphia. I walked through it. So I mean, where's the smart money buying? Where are they operating? They're doing some research here. They're obviously having access to a lot more data than most of us are ever going to sit down and go through. Zillow has a lot of great data. You can go to Zillow Research and you can pull spreadsheets and you can rank them, you can rate them. I do not know how accurate they are. I've done a lot of research through Redfin, Trulia, Zillow, and there's some holes in their marketing information. As an example, Zillow is going to report sold incorrectly, oftentimes a lot of houses that actually didn't go to settlement. Whereas MLS research in the same neighborhood is going to be much more effective. So it may not give you an entire picture, and also the Zillow information of sold houses may not include the houses where agents were like, no, we're not putting this thing on Zillow, we're going to sell it only in the MLS, and so now you have this limited, skewed view of information if you are doing the Zillow research, so you just want to keep that in mind if you're using that as like a real strict tool for picking investments you're going to hold for 10, 15, 20 years. Is it a good starting point, especially if you were to touch down in Minneapolis for the first time? Yeah, I'd say like let's pull the Zillow spreadsheets, do some sorts, and we'll find the first 3 or 4 zip codes, and then I'll go talk to agents about those zip codes before visiting those zip codes and walking around and looking at inventory and pulling my own comps and making a decision with the additional info. But Zillow is a great place to start. We have done a lot of deals in diamond equity as a result of my Zillow research. Cool. Podcast? Anybody listen? Did I waste your time with the podcast?
Never.
No? 138 episodes of money-making guest interviews. I had started this in 2015, I guess. Every other week or so I put an episode up. I'm not selling mentoring, coaching. There's nothing for sale. It's strictly like my own mentoring of myself platform from my guests. So when I find a topic interesting, I ask them to come on the show. They close the door. They're not disturbed. And I like pick their brain for an hour. Like good luck getting access to some of these guests ever to ask them all these questions. Like they're not going to have, these ain't the, oh, let me take you to lunch and pick your brain. Like you're not going to get to do that with a lot of guests. They're too busy, a lot of these people. So I close the door, get them on there, record it, publish that, share that with my audience. When you sign up at reidiamonds.com, the 164-page Become a Real Estate Wholesale Master, a wholesale real estate master. I wrote that book before we started doing 100, 200, 300 deals in a year as a way to like be the roadmap and duplicate my own mindset so that the people on my team could be trained up. That's a bonus you won't find if you go to that site other than if you sign up. I don't promote that anywhere, but you will get a link if you sign up with that PDF. A couple of the favorite episodes, we did one on raising private money for single family flips. Who uses private money to fund your deals? Couple of you? Yeah, cool. Is it game changing to call so-and-so your lender buddy or text them? I send a text message and we fund a $70,000 deal, same day, same afternoon. Text them, wiring instructions are handled by Aaron, we're closing like the same afternoon. It's fast, it's lightning fast. So anyway, I talk about that. That's one of the popular episodes if you go on there and search. One I just completed yesterday was on 1031 exchanges. Anybody ever do a 1031 exchange? Nice. Yeah, I did my first one. I was like, wow, I saved 30 grand in taxes, and I stepped up to a 10-unit building from like a 2-flat frame, and like, wow, this is like mind-blowing. So like, I got the lady, I couldn't get any answers. My attorney told me the wrong information. Oh, you can't buy it in an LLC. You have to buy it in your own name since you sold the house out of your own name, and that's not correct. You can use another LLC. My accountant told me the same thing. You need to do this. And both people, my accountant and 2 attorneys, gave me the wrong information, so I had to get the specialist, Anna Varsky from the 1031 Exchange Company, on the episode. I chased her for weeks and months and sent her like, you know how like if someone's not answering your text and you copy the text and paste it and send the same text, and then you do it a 3rd time, and then eventually I used the never split the difference. Well, I guess it seems like we're never going to get this thing done, are we? And then she replies and she books the episode. But she was well worth the wait and well worth the persistence. It was one of my favorite episodes that I've personally done. And I've noticed that as I've gotten at a higher and higher level in my experience and in the deals I'm doing, the 1031 makes more and more sense because, yeah, like Cosette said, like I'm tired of paying the level of taxes I do. They're huge tax checks. So like not only do we have to pick the right neighborhood and have appreciation and manage the property correctly, but tax efficiency over the course of your lifetime is going to have a substantial impact on your ability to generate a larger portfolio of wealth. That's why Warren Buffett is who Warren Buffett is. He was very good at tax efficient investment strategies, especially early on when you can get away with stuff. It was like John Rockefeller having no income tax. He had really efficient tax strategy back then. It's part of why he made all that money. So the 1031 is something I've come to appreciate a lot more 13 years into the business. Before, 1031 exchange, I glazed my eyes over, like shut the hell up. I just want a wholesale deal and make $20,000. Different story when you get a little further on. We did another episode, so 1031 exchange is not released yet. It'll be out in a week or two. And the other episode that's kind of cool is if you're using hard money or you're having trouble getting your offers accepted. I'll come to your question in a moment. I did an episode with the hard money lender on how like the pros, the guys who are winning all the deals and can't figure out why. And sometimes you look at the settled comp and you're like, oh, I was going to offer more than that. But he got the deal and closed it out. So we go into detail, me and the hard money guy, on how to structure the offer to get the offer accepted. And I'll tell you right now, in Illinois, the standard culture of how you're making offers, it's horrible. It's like, if you tried to do that in Philly or Atlanta or Florida or any other market in the country, they'll laugh you out of there. You'll never get a single deal. So cool, we'll take that question.
I'm curious, the bullet points, can you go there and go directly to those subjects, or do you have to sit through 138 episodes to find this?
If you search them, they're not presented at the top, but they will be. These are going to come if you sign up on the email. The newer episodes haven't been released, but if you click on the, it looks like this, it says listen, then you'll see them all like listed quickly in an order that's like very quickly accessible, as opposed to like scrolling through and letting it load up.
These are the exact names of what it's like.
This one here, raising private money for single family flips, is actually on there. These other two you'll see come out in the email in a week or two, actually maybe a month. Cool? All right, well, I only have a few minutes. Go ahead.
That statement you made right before she asked the question. I'm curious about that. You said offers the way they're done here as opposed to the rest of the country. What do you mean?
Oh,
Laugh at it.
yeah, you get laughed out. I laugh at the offers. Who uses attorney review? Use attorney review? Is anybody not using an attorney review? You submit an offer and you have zero due diligence, zero attorney review. It's an as-is sale. $5,000 contract. $5,000 earnest money deposit in a heartbeat with no attorney review.
Do it both ways because I'm an attorney.
Gotcha. The attorney review is a week way out. You'll never get that stuff past a lot of people. Like any day of the week. So like when I get an offer, if a guy gives me $90,000 offer with zero due diligence, no attorney review, and I have a $95,000 with attorney review, take the 90 all day long. I don't care. This other person has no confidence in their ability to close the deal or make the offer. In my opinion, I don't think that I want to be in bed with that person waiting on and wondering if they're going to close, because 8 out of 10 deals get torpedoed or all picked apart during attorney review anyway. So in a heartbeat, I'm going to take a lower offer with less aggravation, less hair. To me, it's not even an offer until the attorney review expires. So like, all right, let's do the dance. Let's do a 10-day attorney review period dance with you, this buyer I've never met. Half of them have $1,000 or $2,000. Like, you want to get the offers accepted? The gist of that episode is $5,000, $10,000, $20,000 deposit or more. No due diligence, no inspection period, no nothing. You're losing the deposit on that deal if you don't close. You know you're losing that deposit. That's how I have my offers here, whether it's wholesalers I'm buying from or whether it's directly from the seller or whether it's on the MLS. Big deposit, and I don't care. I'm going to lose it. I'm going to pay the deposit. I'm going to buy a deal that I hate because I don't want to lose the big deposit, because I want the deal that bad on the front end. So you don't have to waste your time hunting for the other one now. Cool, any questions?
That's normal culture in the village.
Yeah, Philly, there's no attorney review. There's no inspection period. That's bizarre. Yeah, we do close at title companies. Florida deals close in 5 days, 3 days. Like, you don't have 30 days to close deals. 7 days is a long closing. You better get your stuff together in Florida. It's like 7 days. Yeah. Yeah. Go get, you want home inspection? Go get it done ahead of time at the showing. Yeah. So when you have that kind of confidence in your offer that you're going to get it closed, you're taking a risk that, yeah, you're going to lose a little bit of money, but it's a risk that's probably worth taking because you want the deal that bad and you know you're going to close it. Any other questions? We got time for 2 more questions if anyone has them. You can cut that. Yeah, the question is Florida an attorney state, attorney culture state? Typically it's not, but some people do. Philadelphia is not, but some people do. Atlanta is a little more driven by attorneys. I think it's only attorneys that can do title insurance, right? So you have to use one at least on one side of the transaction for that state. But we don't need attorney review, we just make an offer. I don't really buy foreclosures from the bank right now. They're all retail. That's pretty much what we're dealing with. But we still have title insurance. You're not buying a property like as is with no title. There is title insurance. The title still has to be delivered clear. That's another contract clause. So I found that most people when I dealt with early on in Illinois were afraid to do anything at all without their attorney reviewing the contract before they sign the contract, which still has attorney review, and they want their attorney to mark up the contract before they'll even sign it. Never mind, I'll just flip the house myself. It's fine. Just forget about it. It's just like, so like it's refreshing when I run into someone, and he might be an attorney, and they show up and they say, okay, great, yeah, I'm good to go, here. And they sign a contract that's actually gonna close. And the higher up I've gone with people who've gotten better deals, their confidence and ability and willingness to sign the contract with a larger deposit has hands down netted them better deals across the board than the people who are like aggravating to deal with because of the level of all of those things that come in the contract. And I know, Dan, I'm not giving